Somebody's in a good mood. Welcome, my friends. It's a Thursday before Thanksgiving. I have some thanks to give to you, to God, and to foresight, to experience. Oh, it's going to be a good one today. Woo-wee. Oh, we got a good one. Imagine you knew exactly what was going to happen. You just didn't know precisely when it was going to happen, but you know exactly what is going to happen, and you know the when is drawing near. That is exactly where I am right now. Precisely where I am right now. I know what's going to happen. I've been talking to you about it for some time, but we haven't been able to really see the light at the end of the tunnel until recently. We're going to look at a lot of charts today. I'm going to explain to you what's going on. Irrefutable stuff from an evidence standpoint is overwhelming. What's taking place? The bold prediction, and this is the hard part for people to swallow, is home prices set to soar next year. People don't like to hear that. Most people are rooting for home prices to go down because that's what they think should happen, and that's what they personally want to happen. I got bad news for those people. I've had bad news for people for some time. And today we're going to break it down. And before I get to the bond chart and we look at what's going on with rates specifically right now, which rates are down significantly this week, even last week, rates are down. We're off the highs. People kept asking me for this, and so I'm going to go ahead and share it with you. If you look at the average price of a home, let's go back to around 2000 or so. Here, let's get this one up first. Mortgage rates. Okay. You have to go back to, in the early 2000 range to find rates that are higher than today's. So you want to get, so you get an equal comparison of when last time rates were this high. You have to go back about 23, 24 years ago is what you're talking about. Now, if you go back 23, 24 years on real estate, and we were going from average home price in the country from 431,000 to, 160, 170,000. So for the people, who wanted to see that, I've been telling you, you can look at interest rates, you can look at prices. They don't, there's just not a correlation. The only correlation that there is, as rates go up significantly, housing appreciation slows down. It stalls until rates go back down, and then it resumes. That's very easy to see. It should be noted as well that in Q3, home values nationwide did go up $12,500 on a $418,500 basis. So $418,500 divided by 12,500. Come on, guys. 418,500 divided by 12,500. I can't be right. I'm doing this wrong. 12,500 divided by 418,500. You got to do the math right, Derrick. 3%. So last quarter, the average home price of homes sold in the United States actually went up 3%. So we had a pullback. We've had the stall, and the resumption of movement seems to have begun. Well, let's take a close look here. I think this will be helpful. If we go ahead, and by the way, we are live on all sorts of places. If you want to drop a comment, I don't know what is going on here. Good question. Yeah, I'll take questions. We're live on YouTube, Facebook, not on Instagram, LinkedIn, Twitter. Definitely have been seeing a steady stream of mortgage applications this entire time. Honestly, it hasn't been crazy, but I've definitely seen a steady stream of mortgage applications. The difference is, people getting pre-approved and then kind of disappearing, or just saying, hey, we haven't found anything we're really interested in yet. That percentage has gone up a lot. So I'm not too worried about quantity of mortgage applications. I'm looking at other important data points. So let's take a look at this here. Let me pull this up. This is the mortgage bond chart. This is going to give you an idea, and then I will complete this by showing you the stock chart so we can put the whole piece together, the whole puzzle. I believe I have the whole thing solved. And I'll put my rates up here for a second for today. Now, these rates are based off of 780 credit, detached homes. And then I use minimum down payments for everything except for the high balance ARM and jumbo, which do 20% down to quote those. So you can see rates much lower than we've seen in the past couple of weeks, down 0.5 to 0.75%, pretty much across the board. Nicely into the 6s on the govies, low 7s for conventional with good credit there and minimum down payment. You can get even lower rates than that if you have a big down payment. High balance ARMs and the jumbo ARMs really haven't improved. Like the high balance jumbo haven't moved much. Particular ARMs haven't moved much. Non-QM stuff like the DSCR type loans and bank statement loans haven't moved a ton. There's a little bit of movement there, but not much yet. And those, of course, aren't based off of the same things. But let's take a look at the big guy here, okay? Now, this is the 6% coupon. And it's been well chronicled. I've been talking about this market structure. We have all these lower lows, and then we finally made a higher high. And I was just waiting for us to make a lower high. Sorry, a higher low right here. So we have the low, and then we have a higher low. So we now have an uptrend. We have a legitimate uptrend in mortgage bonds. This is what we want to see. You want to see bond prices going higher because that means mortgage rates will go lower. And so this is terrific. We got the little teeny tiny pullback, blasted back through to make another high. So now we have another higher high. And then today, another high. So price is really going. Why is this happening? I've told you about Wall Street being short bonds. Bill Ackman pulled his short, covered, said, I'm out. I don't think it's smart to sell bonds anymore. And a lot of people in Wall Street are going to be following this. It's a capitulation that we're going to watch happen here. It's going to be a slow burn. Very wealthy people are going to lose a lot of money on this trade. Some of these hedge fund guys are going to go out of business. Some are probably going to jump out of buildings. It's bad things going to happen on that because too many people got in on this trade too late. Bond prices set to go higher. Mortgage rates will likely go lower much quicker than we would all like to. We would like for them to just slowly tick down, nice and calm. It's probably not going to happen. Probably not going to happen. But you can see the game has finally changed after all these lower highs that we had. I mean, so many in a row. And lower lows. Just lower highs and lower lows, guys. This is what we've been working with. We finally have a market structure shift in bonds. That's piece one of the puzzle. Piece two. Look at the S&P. Now, we were in an upward channel on the S&P, so wasn't anything crazy there. We hit significant resistance and then shot outside of the channel. What marked the bottom right here? This right here is the last time that we've heard from our good buddy, Jerry Powell. So the last time he spoke, now I've gone through the Fed minutes. I've gone through this stuff dozens of times, probably a lot. I looked at it a lot, trying to figure out what is it that he said? What is it that they, what happened? What is it that they wrote down in their release? What is it that's being held on to that's so bullish? Why did prices just start going crazy? Why? Remember, when they raise rates, that makes the dollar stronger, which means that prices of things should go down. It's deflationary. When they cut rates, that means prices should go up. The market is always trying to predict 6 months into the future. So market take from this, it doesn't even matter what it was. I couldn't find it. But clearly, very, very clear based on the prices of things, you could look at all sorts of stuff. But just looking at the S&P here, straight up, straight up, headed to this big resistance up here. We'll see what happens up there. But this tells you that the market believes that the Fed will be cutting rates. Then you go and you look at the sentiment and the surveys on expectations for rates next year, and everyone's expecting rates to get cut next year. Everybody, including the entire market. So the market is telling the rate of your future. We know what happens as rates go down. Prices will go up. So although I'm telling you prediction, something we've been talking about for some time now, we're close. We're very close. And I think the last bit of this year, we're going to get a taste of it. And next year, my guess is it is full on gangbusters next year. Next year, just get ready because people are going to be trigger pulling.
Yeah.
Big time. All right. What's up, Jason? Do not do New York. We are licensed in Florida. So my company can help you in Florida, but not in New York. New York's a much more difficult state. We can do a bunch of different states, including Washington, Idaho, Georgia, Tennessee, Texas, Florida. We got North Carolina and Virginia in the works. I feel like I'm forgetting one right now. Arizona is another one. Colorado is another one. So, yeah, we've got a bunch of different states, but not New York. New York's a tough one. Thanks for the question. I will get the question. If you guys want to say something, you want to ask a question, if you want to make a comment, feel free to do so. So now we can follow the money. We see the bond short exodus. By the way, the reason why Bill Ackman said I'm getting out is because he believed it was a good time to invest in those bonds to lock in those returns. Just mind you, right now, you can buy a bond. Okay, you can buy a bond that will pay you 5-6%, and you can get that locked in for 30 years. That's wild, right? That's locked in return. Now, what happens if rates drop? That would be because those bond prices are going up, which means that your bond trade, your safe trade, your hey, I want to make 6% a year trade may make 6% in 6 months. Plus, you still get the yield because there's the principal value of the bond and there's the yield. Think about bonds as being a stock that has a dividend. It's basically what it is. So the bond trade, very sexy. I've been saying this for some now. I can't believe there isn't more people interested in these bonds. I can't believe it takes so long for the bond market to cover paying these kinds of rates. See, your savings account, well, they pay you 4.5% today. If rates go down tomorrow, they'll just lower it. They don't owe you anything. There's no term on that. Maybe a CD is a different story. But your savings account, your money market account, a place where people are kind of holding cash, they that. But with the bond, you get your money. Okay? And then you get your full principal or 100 returned to you when the period is done, and you make your yield along the way. And if you want to sell prior to then, you most certainly can if prices go up. And that's what Bill Ackman's expecting. That's what I'm expecting. Now, people are starting to see that this is the reason why I believe right now the real bold prediction is not what's going to happen next year. The bold prediction is what right now is. What is right now? Right now is the moment. Right now is the moment that so many people have been waiting for. I'm trying to explain to you. This is what it looks like. You know what it looks like? I believe this is it. That moment where you can see where everything is actually, it's not just hypothesis. We have data. You can see things are starting to line up, where the tide is turning, where the worst of it's behind us. Rates start to come down nice and quickly. The path lower seems to be the least resistance again, finally. But most buyers don't know yet. Most buyers are unaware. Most sellers don't know yet. Most sellers are unaware. Most professionals don't really know or understand what's happening. They are unaware. You're just starting to see a sprinkle of sentiment. Homebuilder sentiment drops. Who cares? Sorry, homebuilders. I don't care. But falling rates spur optimism. They sure do. Mortgage demand climbs to the highest level in 5 weeks after interest rates move lower. Starting to see these things. We did a seminar last night and some people were commenting to me, yeah, I noticed in the news the rates are lower. But they didn't really know what that means yet. It isn't something that's like, oh, well, they're record breaking. It's just starting to sprinkle out there a little bit. Cooler inflation report pushes mortgage rates even lower. These are just stories from this week. So people are starting to see, but it hasn't become full-fledged, this is the way the market is yet. It hasn't spurred a ton of action yet. But I tell you what will happen. Let's pull this guy back up. Where is it? When bonds are trading up here, we're still not even at 100 par. Okay. So you can still buy this bond 6% for what? That's a crazy thing. And there's going to be more, in my opinion, there's going to be more institutions that are interested in that. Okay. There's going to be more money that gets put to work in the bond market. It just makes sense. It's been way overdue. I think some people have some plugged in institutional money managers have stayed away from it because they knew the pillaging that was taking place. They have buddies on Wall Street they went to Harvard with who are telling them, yeah, we're just going to murder this bond market. And they're like, okay, better not buy that. And then Ackman says, I'm out. And people start going, ooh, maybe we should get in. Not short, but long. See, when he covers his short, he's buying to get out. So you can see that just start to roll over. And when prices get up to 102, 103, rates will be, if they just get up to here, that's rates 1% lower than they are right now. So take this and subtract 1% from everything and tell me what you think the market's going to do. Tell me what you think the market looks like when VA rates are 5.5, FHA are 5.5, conventional rates are 6. People are throwing out 5.99s. What do you think is going to happen? Now, the difference is, here's the big difference. The last time we had a frenzied market, remember that was during the COVID crisis. We had a lot more inventory back then than we do now. A lot more. And we are still lacking the inventory. So if we get a demand surge like we had at that time, it may not be quite like that, but if it's even anywhere close, I think it could actually be worse, but it may not be. By the way, gained 45 basis points today. So if it is, we've got a lot less inventory to deal with, which means it'll be even crazier. You thought it was crazy last time, it'll be crazier this time, meaning number of offers per property, so on and so forth. Now, that doesn't mean that there won't be opportunities. It just means that the people who are enter the market, who have been waiting, the sell buyers, they need to sell a house to buy the next one, they cancel themselves out from an inventory perspective, right? They're selling one house and buying another one. So that's a wash from an inventory standpoint. Even though we'll create more transactions, which will be good for people in the business, realtors, title, escrow, lenders like myself, there'll be more units, more deals happening. That'll be good for us. But it won't necessarily solve the inventory crisis. It won't. It will create more opportunities, but it will also create more chaos because there's going to be way more buyers that are into the market than there will be supply. So that's where we're at. Okay. Now, just to give you some perspective, to get up to, these areas here, let me just show you what I'm talking about here. Dropping 1% in interest rates from where we are right now means getting to about 103. So perspective on that is essentially the move that we just made, okay, from here, from 97 to where we are right now, that right there. How long did it take us to make that? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 business days. That's 3 weeks. That's how long it took us to go this last 300 basis points. 3 weeks, 100 basis points a week. That's not even that crazy. If we start to see real capitulation, that could happen in 2 days, 3 days. But if we just stay on this course that we're on right now, this trajectory right here, rates will be 1% lower, 1% lower in about 3 weeks. I'm not saying that we necessarily will, but that's what I'm telling you. I don't know what is going to take place. And it is much closer now, much closer than it has been. A lot of people know it. A lot of people don't want to believe it. A lot of people don't like it. I'm sorry. I don't want to be the person telling you something that you don't like. But for everyone who's waiting for house prices to come down because prices have outpaced median income, there's a gigantic disappointment coming. I can sleep well because I've warned you. But that is what's happening. So now, do you see how real this is? Do you see how close this is? This run right here isn't even that significant yet. All we're doing is creating market structure. But notice the big candles are all green. The red ones are teeny tiny little guys. All the big moves, all the big money moves here recently have all been to the upside. I think that trend could continue for quite some time. Will we see rates in the 2s and 3s again? Possibly, but not soon, but possibly this cycle, especially if the Fed, we're looking over here at why in the world does the stock market do a fake below this massive macro trend line, a fake below, and then back into the range. That doesn't happen for small moves. This is not the kind of action you would see where like they take it down and fake it and then come back up and then fake it back down. That's not very likely to happen at all. This was the fake out. That was the fakie. That was designed to get everyone bearish as possible. And that's how you see these huge gaps here between days. One pullback and then scorched higher. I mean, this is all the makings of new all-time highs for the stock market incoming. If you had told me back here before anything to the right happened, hey, they're going to make new all-time highs on the stock market, I said, yeah, well, they're going to have to really slingshot it if you're going to do that, right? There's a lot of resistance up here. You're going to have to really slingshot it. And that's exactly what this is. Take it down below the trend line, get everyone turbo bearish, options activity becomes crazy on the put side, and then you just rock it, just rip everyone's face off. And that's what they're in the process of doing right now. Market just won't go down. Like even this one day where we had like kind of a down day, that was really it. And immediately after that, just turbocharged higher. So that was totally, again, a fakie. So whenever you notice that moves down are fakes, especially on a macro side like this, I mean, there is a lot more coming. They didn't do this just to go to here. This wasn't created just to get to this point. This was created to make a much higher price out of the stock market, which some people like myself, you can't believe it. It just doesn't seem like it makes any sense. But there's no way they're done there. No way. And it's fueled by and timed by the expectation of the Federal Reserve lowering interest rates. So we take that in conjunction with what's going on in the bond market and the overall shift in sentiment and optimism that you're going to start to see come in as the news continues to drop. Hey, mortgage rates fall again. Mortgage rates down to their lowest levels in 18 months. You're going to start to see those kinds of headlines. Those kinds of headlines are what's going to drive buyers off the fence and into the market or back into the market for people who have already been pre-approved and have been looking. What's up, Jason? Info on the 5% down duplex program out soon. Rates, terms, just. I don't think anyone has specifics on that yet. I don't think there's going to be huge demand for that either, by the way. But there is something that I do want to talk about, and this is absolutely huge for the time being. So we're talking about rates going lower, stuff like that, but we're not there yet, right? We're not quite there yet. So what do we got here? Okay, let me show you something. Let me show you something. I don't think I need to have that. I have a bunch of cool things like this. All we want to do is pump you up. But I don't have all of my old radio sound effects. Now, a couple things. So what I'm about to show you here, this is very new for the broker world. I know there's some banks who have done this in the past and maybe still do it out there. But the 2-1 buy down, the temporary buy down opportunity is massive. The hard part that people have had is that, well, the seller has to pay for it. It's hard in these competitive situations for the seller to pay for temporary buy down. The temporary rate buy downs are superior to the long-term or traditional rate buy downs, in my opinion, because The traditional rate buy downs take 3-4 years to break even. So if you refinance within the next 3-4 years, you lose the money. It's a loss. You flushed it down the toilet. I don't think I have that on here anymore. I used to have a toilet flush sound. We'll just say this. You'll lose the money. Temporary rate buy down. If you do refinance, then you just, whatever unused subsidy you have remaining, it just gets credited to your loan balance. Lose. Now, if you can't get the seller to pay for it, a lot of people have said, well, can I pay for it? And that just hasn't worked until now. And what's really cool about this, there's two things. Number one, you can pay for it through a higher interest rate. Sounds weird, right? I get a lower interest rate? Yes. Or you can pay cash. So for the 1.0 buy down, which is 1% lower in the first year, and that's it, and then back to your full rate, it costs 0.875%. And I'll send anyone who wants this calculator. I just made a video on this today. It's on my YouTube, just going through specifically this, if you want a more detailed explanation on it. And then I'm going to look at a couple more charts here in a second. Of course, we'll take your questions if you want to comment, a question, say hi, whatever. So 0.875%. So you can pay 0.875%, which is a little less than 1 point. And then you get a temporary rate buy down instead of a permanent rate buy down. So now, instead of getting 6.5 on this VA scenario I have set up here at $750,000, you get a 5.5%, but you got to pay the point. But you can get some of that refunded if you refinance prior to that first year concluding. Otherwise, the money is just 1-to-1. It's transferred from here to your payment. So there's no loss. You could also say, well, there's not really any gain if you're just taking robbing Peter to pay Paul. True, but a lot of people want a lower payment. It's part of your budget. You'd rather not be raiding your savings account, that kind of thing. Now, the other way you can pay for it is you could say, well, I'm going to take a higher note rate. So instead of taking 6.5, for example, on this scenario, you would need to take about a 7%. So you take a 7% note rate, which by taking that slightly higher rate pays for this fee. And then your rate is actually 6% to start for the first year. Now, you would only want to do one of these programs and fund it in that fashion if you believe, like I believe, that rates are going to be headed lower in the near future and you expect to be able to refinance. Otherwise, it would only make sense to pay for it directly as opposed to paying for it through the rate. You can do this on a 1.0 buy down. It's very simple. And if you do a 1.0 buy down, UWM provides this calculator, United Wholesale Mortgage, they will give you an appraisal at no cost. So you can essentially get a free appraisal on top of this buy down, lower your rate without having to get anything from the seller. So you can go make your strongest offer and be in good shape. A lot of buyers don't realize the rates have gone down. They don't realize that they could be more aggressive with their offers. They don't realize that their pre-approvals have gone up. I will be following up with a lot of people tomorrow and explain that. Hey, listen, rates have come down, which means obviously lower payments for the same purchase price, but also your pre-approval has probably gone up a little bit. So we, in my business, in my profession, we have to follow up. And it's very difficult because the market can move both directions, right? When rates are going up, it's like, hey, your pre-approval is going down. I'm sorry. When rates go down, your pre-approval is going up. You're not pre-approved for a dollar amount, you're pre-approved for a payment amount. So that's how it works. So no cost appraisals for the 1.0. And you can do a 1.1 buy down, which is where it's 1% lower for the first 2 years. You can do a 2.1 buy down, where it's 2% lower for the first year, 1% lower for the second year. And you can do a 3-2-1 buy down, where it's 3% lower for the first year, 2% lower for the second year, 1% lower for the third year, and then you go to the note rate in the fourth year. I think that's silly, personally, because I don't think it's going to take that long to refinance, but that's just my opinion. I could be wrong, of course, about my opinion. I think 2-1 is about as far as you want to go, but this calculator has it all. So whether you're a buyer looking to buy, you're a realtor, you would like this calculator, or you're another lender, it doesn't make any difference to me. I'll send it to you. I'll send you this calculator. Just send me a text or an email, and we can do that. And so you get a free appraisal from UWM, and you can get this buy down covered inside of the interest rate. I just think that's so crazy awesome and something that hasn't existed and people have definitely wanted. Okay. We're going to do a couple more charts here from the goodies. Let's look at economic calendar real quick here. Finishing up the week. Oh my gosh. 17th is tomorrow. Got housing starts, building permits. I don't think it's going to be a huge market mover, but we'll see if maybe it's way off. It would be. You got a bunch of Fed presidents speaking and stuff like that. Nothing really too crazy going on tomorrow. But I do expect volatility in the market because it's Friday. You know what happens on Fridays. Money doesn't really get put to work. The market just gets manipulated, essentially. That's what happens. So we can expect volatility there. Couple things. All right, crypto's been on fire. Yeah, let's do crypto. Bitcoin. So you notice I like to always know what kind of channel the market is in currently, right? I have channels on almost all of these charts because you can see what's going on with these channels. This is where price is being driven. As of right now, Bitcoin is at the top of its channel, which is always a very difficult place to get out of. It's always it's hard to, if you're in an upward channel, to break the top range, because the expectation in an upward channel is that it's going to sell off. It's closed above a couple of times, and each time it's rejected pretty hard. Crypto has, particularly Bitcoin, has a big opportunity in this ETF approval, which a lot of people believe is going to happen very soon. When it does, I do expect Bitcoin to spike hard, maybe for a day or two or a week or two top, maybe, and then you're going to see probably a pretty big sell-off from there. But it's you could just see the buying pressure is insane right now, as institutional demand is coming to the marketplace, and the bottom for Bitcoin appears to be in. That's a really good looking chart. Tesla's been all over the place. It continues to meet with this macro downtrend line. Just a very simple trend line on the daily chart here. You can see it stuck its head above for 1-2 days and then just ripped lower. It came back up and touched it again and then fought it, made a lower high, and it just fell like crazy from there. I still think personally that Tesla is, people will look back on it and go, what the hell was I doing? Everyone knows who Elon Musk is. Everyone knows he's a genius. Everyone knows that he's building robots, that Tesla has the best AI. It's the best AI investment, in my opinion. An amazing car company as well. They make amazing cars that are made 100% in America. I mean, that's pretty wild, right? Well, not 100% in America. The ones in America are made in America, but they have gigafactories in different countries too, where they make them locally. But so there's so much here. When you look at the valuation, I'm still very bullish on it, but we're in a downward channel here. Downward channel, rejecting off of this. So there's pressure to the downside. What we will see, I believe, one day with Tesla is we're going to see it break these resistance levels. You see it come up and actually truly create market structure above, and then it can really do its thing. But it's got to do that. It can't just, these look above and fails. These are just, those are bearish, and so sellers are there and they're hitting it pretty hard. Meta, remember we doubled the zone down here. We had this channel. And it broke below, but then it started going higher. And so you just create a new channel. Did a fake below on this one. And now it's back into the lower channel. So it's just like relentlessly going higher. These stocks are, particularly since we heard from our good friend Jerry Powell most recently. And I don't see any reason why we should think that that's going to stop anytime soon. It does not look like they did this to double pump fake, right? Could be a double pump fake, right? Pump fake lower, pump fake higher, and then crush it. It's always possible. It's always possible. It's very expensive to pull this off. So it just doesn't seem like it would make sense when the market kind of already wants to go lower. If they just pull the bid, the market would dump. And they're in there pushing it. There must just be an insane amount of liquidity higher. I mean, it must just be insane. Trillions, probably. And they're going to grab that. That is what's happening. They are going to get that. They're coming for it. So we should obviously talk to your financial advisor about your investments. These are just the ones that I follow, the ones that I like, the ones that I'm invested in. I actually still don't own any Meta. I sold it all at $295. Like, I don't want to say like a fool, because I was up very nicely, but I thought that it was done when it broke the channel initially, and I got out shortly thereafter. And look what's happened. They got me. They got me to sell. I sold my shares probably to some hedge fund. And they have them now and they were 335. So that's what's going on. Meanwhile, cash is making 4.5%. There's nothing wrong with that, but I don't expect that to last too much longer. If you like the 4.5%, 4% you're making your savings account, you need to consider locking it in with a CD or buying a bond. because I think those days are definitely numbered, and the market is showing us that it believes that too. So it don't have to just be my opinion. You can see the market's telling us something here, and it's significant. So let's see here. I think I have. All right, we'll sign off in a second. Hansi. Yes, sir. Will do, Hansi. I will send you the buy down calculator. No problemo. In fact, I'll do it as soon as I sign off here. All right, guys. With me today. I'm gonna get back to some people. I think I'll play with my kiddos. So have a great evening. If you want to get in on any of this, if you want access to the calculator, you want to hear more about this, you want me to plug in your specific scenario, or you just want to get a wholesale home loan rate with no lender fees, no BS, no junk fees, no crap. You want to overpay, just want to get a good deal on a home loan, give me a call, shoot me a text, send me an email, and I will hook you up like a tow truck. Have a great night. I'll see you again soon.